Okay, good afternoon, everybody. Welcome to the Economic Society of Australia seminar on additive productivity growth. We're very pleased to have Angus Wheeler presenting the work he's done with Keaton Jenner from New South Wales Treasury. Before we start, I'll just acknowledge that we're coming to you today from the land of the Gadigal people of the Eora Nation. If you have any questions, put them into the chat, and I think your preference, Angus, is to deal with the questions at the end.
Yeah.
I'll leave it at that. Over to you.
Cool. Thanks, Richard. Thanks everyone for coming and for joining online. Let's see if I can change slides. Right. Last year, Keith, Jenner, and I wrote a New South Wales Treasury research paper called Trends in Productivity, What Should We Expect? The paper got a bit of coverage, including from one of the legends of the game, Ross Gittins, the SMH. The paper probably got that sort of coverage because it argues for a fairly fundamental rethink of how productivity growth works. And it puts forward a new model that could help explain a part of the recent productivity slowdown in Australia. Today, I'll walk you through some key results, and then, let's have some questions at the end. Just a quick disclaimer as well, the views I'll express today are my own and don't necessarily reflect the views of New South Wales Treasury as a whole. To start with, a few facts to motivate our paper. So there's been significant declines in total factor productivity growth rates across a number of advanced economies over recent decades. You can see that a little bit on the chart on the left there. To refresh everyone's memory, a few quick definitions: labour productivity output divided by labour input, and productivity and growth in labour productivity can come from two main sources: increases in the amounts of capital per worker, deepening, or growth in this residual term, total factor productivity, also sometimes known as multi-factor productivity, but today it will be TFP. TFP is a measure basically of how effectively we're combining our given capital and labour inputs to produce output. Reflects things like new ideas, products, processes, but also how well we're allocating resources to their most productive uses. TFP has been largely responsible for the declines in labour productivity over recent decades, and TFP will be the main focus of our presentation today, although we will also touch on labour productivity as well. Why do we care about these declines? Well, because productivity matters for a lot of the things that we care about. So productivity growth is a key determinant of long-run real wages growth, but also things like business investment and GDP growth, which you can see on the right. The slowing TFP growth, which is black segment there, has been weighing on GDP growth in purple over recent decades. And the slowdowns puzzled economists. There have been a whole host of explanations put forward. I won't go into these in any sort of detail, but the point is a number of explanations, but thus far, no sort of silver bullet explanation put forward and no consensus view formed. And the slowdown's been particularly puzzling because standard growth models assume that TFP should grow at a constant growth rate over time. So TFP should be exponential over time, as you can see in that top right chart. But today, I'll show some evidence for Australia, as well as previous evidence for the US and the UK, that actually TFP grows at constant increments or amounts. The TFP will grow linearly over time. And then as the total TFP level grows over time, those constant increments or amounts will translate to lower and lower annual TFP growth rates. You can see sort of what I mean in this mock-up of linear TFP, which we've got in the bottom right. Say TFP increases by 5 unit increments. When the total level of TFP is 50 units, that's 10% growth. But in 10 years' time, when the total TFP level is 100, another 5 unit increment, only 5% growth. And if you think about what this means for the productivity slowdown puzzle that we've been talking about just before, and at the risk of ruining my whole presentation, it's like going to McDonald's. It's like going to McDonald's and expecting the quarter pounder from the ad and then always being disappointed when every time you get something that looks more like, right. You can say the same thing, please bear with me, about the productivity puzzle. The puzzle is partly a result of us comparing ourselves to this unrealistically high benchmark of exponential growth. And much like the quarter pounder has never looked like the ad, we make the case in our paper that TFP has never grown exponentially, it grows linearly, and we should be comparing ourselves to that lower linear benchmark. It seems like that analogy worked, at least for some of you, but I'll just get into the results now. So this new additive growth model that we're discussing today was first proposed by NYU's Thomas Philippon in 2022. He tested the model for the US, and I'll take you through what he found. We've replicated his key results here. So first, he wanted to test how well a linear model would fit actual US TFP for the post-World War II period. And then compare that with how well a standard or exponential model would fit the same data. And to do that, he takes the first half of the post-World War II period, and he uses that data to fit two models, a linear model and an exponential model. And then with those two estimated curves, he sort of extends those curves forward to produce simple sort of out of sample forecasts for the remainder of the post-World War II period. So everything to the right of that black dotted line. And so I'll show you what he found. Here's, again, actual US TFP in purple. Here's the forecast from the standard or exponential model. As you can see, it significantly overshoots actual US TFP for the post-World War II period. And here's the linear or additive model. You can see it fits actual US TFP data pretty well for the period, and you can see better than the exponential model. So obviously there are periods where actual US TFP will grow slightly slower or slightly faster than that linear trend, but it provides some evidence that US TFP has been growing roughly linearly since World War II rather than roughly exponentially. Anyway, we did the same thing for Australia. We test the same model. Again, here's actual Australian TFP indexed. Here's the exponential model forecast. It implies a constant annual TFP growth rate of around 1.7%. And you can see, like with the US, significantly overshoots actual Australian TFP. And here's our linear or additive model forecast. It implies that TFP will increase by around 2.4% of 1947 starting TFP level each year. And that translates to annual TFP growth rates that taper down from 1.25% in 1984 to 0.9% by 2019. And you can see again, it fits Australian TFP data reasonably well, and better than the exponential model, although it is still worth noting that the additive model forecast here is still slightly optimistic. A few quick robustness checks on that main result. So first you might be asking, well, are those results just driven by the specific period of data that you've chosen to fit your models with? And to address that, we've got some alternative fit periods here. So on the left, we fit our models with the 1937 to 1973 period, so shifting the fit period back by 10 years. On the right, we shift the fit period forward by 10 years. And you can see that the choice of fit period does affect our forecasts. But under both of these alternative fit periods, like with the main specification that I've just shown you, the additive model fits actual Australian TFP better than the exponential model. We then go a step further and produce the same sorts of forecasts, but with a rolling fit period window. So we start in 1937 to 1973, produce those forecasts, we shift the fit period forward by a year, produce the same forecast, so on, so on, so on. And under every one of these rolling fit period windows, the additive model outperforms the exponential model. So we've seen some evidence that Australian TFP appears to grow roughly linearly since the end of World War II. But what if we look back further than that? So the growth model doesn't argue that TFP has been on the same linear trajectory since like before the Industrial Revolution. Instead, argues that TFP grows roughly linearly over long periods, also known as productivity regimes. But these productivity regimes are separated by major structural breaks in the series. And series is said to have a structural break when two or more segments have significantly different shapes. You can see an example of what I mean in that bottom right chart. And here's what Philippon finds when he looks back to the pre-industrial revolution period. So here he's looking at the UK, where we have the longest possible time series, and also because the UK is considered the sort of technological frontier country for that period. And he finds evidence of long periods of linear TFP growth separated by these major structural breaks, followed by a return to linear TFP growth with a different slope. You can see those periods breaks here are around 1650 to around 1830, around 1830 to around 1930, and then around 1930 to the present, which I'll show you in a second. And perhaps convincingly, these periods and breaks correspond with major technological breakthroughs and the introduction of general purpose technologies, or GPTs. So think like the steam engine or electricity. For instance, economic historians typically date the widespread integration of the steam engine into production by around 1830, and the widespread electrification of the economy at around 1930. So Philippon's suggesting that these GPTs are shifting these economies into these new productivity regimes. Another thing's worth noting here is that if you take this really zoomed out view of TFP over 300, 400 years, it does start to look exponential. But Philippon's point is that over these long periods or productivity regimes, and these periods can last 100, 150, 180 years, the TFP is actually growing linearly. And if we're expecting TFP to grow exponentially each year, then we're going to be consistently disappointed and confused as to why TFP growth rates are falling within these productivity regimes over the medium term. Philippon does the same thing looking at the US for the later period. The US is considered to be the sort of technological frontier. And from the start of the data in 1890, finds evidence of roughly linear TFP growth from the start of the data to around 1930, potentially to do with electrification, major structural break then, and a return to roughly linear TFP growth from around 1930 to the present. We did the same thing in our paper for Australia. We see quite a similar pattern for Australia as what Philippon found for the US. From the start of our data to around 1930, roughly linear TFP growth, major structural break around 1930, and a return to roughly linear TFP growth from around 1930 to the present. Another interesting result you can see here in the 90s. Seen an acceleration of TFP growth, potentially to do with the tech boom, but also maybe the sort of major structural reforms that were happening around that time. And we do see this acceleration even under the additive model, but crucially, we don't identify a major structural break that sets us on a new growth trajectory, a new productivity regime. And that's the same as what Philippon found for the US. So we've seen that linear TFP growth is not necessarily a recent phenomenon, and seems to exist across a few different advanced economies. What does TFP mean for labour productivity? This formula for labour productivity comes from the Cobb-Douglas production function divided through by labour, and labour productivity here expressed as a function of A, which is TFP, lowercase k, which is our capital labour ratio or capital intensity, and alpha, which is assumed to be the capital income share. I won't go into more of the maths, but it turns out that under linear TFP, capital intensity will also be linear, grow linearly over time. And so we do a similar thing for capital intensity as what we did for TFP. We produce linear capital intensity forecasts plug them back into that formula with our linear TFP forecasts and values for the capital share, and that generates labour productivity forecasts under additive TFP. And you can see those on the right. That our labour productivity forecasts under additive TFP fit actual labour productivity data pretty well, and much better than the sort of standard exponential model. It also turns out that under additive TFP, this labour productivity forecast will be slightly convex, so it'll increase in ever-increasing increments, so slightly faster than linear, but crucially much slower than exponential. But it does mean that additive growth in TFP doesn't necessarily imply stagnation in labour productivity and living standards over time. Now let's think about how additive growth might actually work in terms of the micro foundations of the model. Let's consider a sort of a standard growth model like Romer's semi-endogenous growth, where TFP grows basically 1-for-1 with the growth of ideas, and ideas grow in proportion to research effort. Research efforts assumed to be a function of the number of researchers multiplied by their research productivity. And since research productivity is assumed to be constant over time, and the number of researchers is assumed to grow exponentially with the growth in population, that generates exponential growth in research effort, which in turn generates exponential growth in ideas and exponential growth in TFP. That's sort of an example of how a standard model could generate exponential TFP growth within the model. And we have seen some evidence that the number of researchers is growing exponentially over time. That chart there on the right, your light green line there is from Bloom and Van Reenen. They find the number of researchers seems to be growing roughly exponentially over time. So what needs to change in that standard model setup so that that exponential growth in the number of researchers doesn't translate to exponential TFP, but linear TFP growth? Well, one explanation put forward by Bloom and Van Reenen is that this research productivity term, maybe it's not constant over time, maybe it's falling over time. And they show some evidence that research productivity has declined over recent decades pretty significantly. And so maybe the number of researchers is growing and their productivity is declining at exactly the right rates to sort of offset each other and generate linear TFP. But one issue with that is that some other papers, Kelly et al. 2021, found that actually useful ideas seem to still be growing exponentially. So what could be happening in the flow through from ideas to TFP so that this exponential growth in ideas doesn't generate exponential TFP growth, but linear TFP growth? Philippon and Volrath suggest that maybe TFP doesn't grow sort of 1-for-1 with ideas. Maybe there are these sharply diminishing TFP returns to ideas. Maybe TFP grows with the natural log of ideas following sort of a shape like what we see on the right here. So if ideas are growing exponentially, but TFP is growing with the natural log of those ideas, that would generate the linear growth in TFP. In terms of why you might expect these sharply diminishing TFP returns to ideas, Volrath argues that maybe that's because each new idea has to interact with an increasing number of existing ideas. Take driverless cars could represent a huge productivity boost in a simple road network, but their current utility is constrained by the need to interact with an increasingly complex road network, other vehicles, pedestrians, buildings, etc. This isn't to say that this is how additive growth is generated, but it illustrates how additive growth could be reconciled with exponential growth in the number of researchers, exponential growth in ideas within sort of a standard model setup. Now let's chat about some possible implications from some of these results, first in terms of our macro projections. So federal and state treasuries typically assume a constant rate of productivity growth in their forecasts. For example, 21-22 New South Wales intergenerational report produces forecasts at 2041, and they assume a constant rate of labour productivity growth of 1.2%, coupled with some assumptions about population and participation trends, translates to gross state product growth rate of 2.2% per annum. But as you can see on the right here, the additive model has fairly different projections about labour productivity growth. Specifically, it projects that labour productivity annual growth rates will fall from 1% to 0.8% over the forecast horizon, rather than remaining constant at 1.2%. And coupled with those same assumptions about population and participation, translates to GSP growth rate of 1.9% on average per annum, compared to 2.2%. Basically, what this means is that by 2041, the New South Wales economy would be 7% smaller under additive model projections than under IGR forecasts, under these very rough back of the envelope calculations. So, potentially a fairly significant impact on macro projections in just a relatively short 15 to 20 year time period. That could then have potential implications for projected tax revenue growth, government budgets, their ability to deliver quality services, and so on. The other key possible implication from additive growth is that innovation today doesn't make innovation tomorrow easier. So for this thought exercise, let's assume that TFP is driven by the stock of useful ideas. Obviously, I know there are other things at play here, for example, like allocative efficiency, but just for this thought exercise, for simplicity, let's think about it. That's driven by ideas. And let's consider a one-off increase in government subsidies for R&D. And assume that it increases the number of useful ideas created today by 1 unit. Sorry. Under the exponential model, the amount of useful ideas created in each period is a function of the current stock of useful ideas. So that one-off increase in government subsidies for R&D won't just increase the amount of ideas created today, but also in each future period. It's sort of called like the intertemporal spillovers from R&D. But under the additive model, the amount of new ideas created in each future period is constant and is not a function of the current stock of ideas. So that one-off increase in government subsidies for R&D would increase the amount of ideas created today, but not the amount of ideas created in each future period. So it won't have these intertemporal spillovers. That doesn't necessarily mean that governments should invest less in R&D under additive growth, but maybe it means that governments should focus their efforts into the sorts of basic research that could generate the new general purpose technologies that could shift us into new productivity regimes. Let's wrap up now with a few caveats, limitations. Firstly, we should take seriously the idea that other theories could fit the data better. For example, maybe productivity growth sort of evolves in terms of long waves of progress followed by stagnation rather than following an exponential or additive process. Second, most of this discussion has assumed that TFP is driven by the stock of useful ideas when, as I've touched on earlier, could be things like changing misallocation could have a role to play here. And I think exploring how changing misallocation could fit within this additive model, I think would be a good idea for future research. And finally, a limitation of any model that features structural breaks is that it's difficult to predict the timing and size of those structural breaks. And so if governments were to incorporate additive model assumptions into their forecasts, potentially a lot more work would need to be done to sort of flesh that out. So today, we've presented some evidence that TFP might not grow exponentially, as standard models assume, and instead it grows linearly. And in terms of the slowdown puzzle, much like over the years, I've learned not to compare the quarter pounder that I get to the ad. The paper says that we shouldn't compare our productivity performance to that exponential benchmark, but instead to a lower linear trend. Anyway, that's all I have. I'll pass it to Richard, but yeah, thanks everyone for listening.
Okay, thanks, Angus. Questions?
What was the actual goodness of it? I mean, it looks pretty good on the graph, but numerically?
Yeah, so we have
I mean,
some.
roughly,
Yeah, so in terms of numerically, we do also calculate root mean squared errors for the different models, and consistently the additive model is lower root mean squared errors than the exponential model, and also lower than some other exponential specifications.
Thanks for your presentation, Angus. That was great. I look at productivity at the RBA. And so I'm interested in this regime shift. It sounds like to me that we were getting excited about potentially going into a new regime in the 90s, or from that experience of the 90s, and that it just kind of hasn't quite worked out as well as we were hoping. And I note that there's a lot of microdata evidence and research that you've personally been involved in that talks about some of the drivers of the decline starting from the early 2000s. So that's difficult because that's when the data kind of starts. It's difficult to go further back. But do you have any views on particularly the allocative efficiency angle of the slowdown and how that might have interacted with the potential new regimes? So maybe we're in it, but these other factors have pushed against it.
Yeah, I mean, I think the big thing that I was thinking about when I was thinking about the 90s and the lack of this, structural break and new productivity regime is often there are pretty significant lags between the sort of introduction of a new technology and then the structural break and the new regime, like something like the steam engine, sort of first introduced late 18th century, but then sort of only effectively integrated into production by like 1830. So a pretty significant lag, and maybe we're still in that lag period. But instead of having to sort of instead of the being generated by needing to like build new infrastructure, maybe it's we need to make the complementary investments in like human capital or managerial capability to sort of properly harness the productivity potential of PCs. And then you've got like AI, which is a whole nother thing.
I'll ask a question, Angus. The productivity puzzle has been around for a long time. I think it was Solo back in the 80s who said, we can see computers everywhere except in the productivity statistics. And the smartphone, I think, started came into our lives in about 2007. So same story for the smartphone. You in your one slide, you had a summary of the different attempts to sort of explain, what might account for our difficulty in seeing evidence of the contribution of these technologies. So, have you got any insight from the work you've done as to how we should think about that specifically? And, if we're looking for the contribution, say, of the smartphone, how would we expect to do that using your framework?
Yeah, so I mean, like part of the question is like, is there still a slowdown under the additive growth model, I guess? The answer is, I think there is still, you can see, I'll just try and pull up the chart that shows it the best. So I think how we would talk about the productivity growth slowdown under the additive framework is that partly it's a result of us comparing ourselves to this exponential benchmark. We would argue that actually for very, very long periods, it's actually been linear. And so under this additive growth framework, when you think about TFP increments rather than TFP growth rates, the slowdown is a lot smaller, but there is still this small. We are still slightly below even historical linear trends. I think in terms of how this paper fits with a lot of the productivity growth slowdown literature, like a lot of that stuff focuses on the slowdown between the 90s and recent decades. And you can still see that even when we're talking about TFP increments, the TFP increments that we've seen in recent decades are slightly smaller than the TFP increments we were seeing in the 90s. So we do still see this slowdown even in TFP increments from the 90s to now. So in that way, I guess we're not directly in tension with a lot of that literature. But I guess we would, when you sort of, in the additive framework, that period looks like potentially just a period of quite strong growth rather than the continuation of a longer lived trend. And that when you compare to like historical averages of increments, we're not that far below. So yeah, in short, there's probably still room for a bit of a slowdown even under this framework, but it seems to explain quite a bit of it.
Interesting the possibility that there could be some elements of society which would create a structural break in the wrong direction. And I'm thinking about the smartphone technology, which, I mean, all of us have seen millennials constantly glued to their phones, doing stuff during work hours, whatever, and perhaps just a dumbing down, kind of reverse Flynn effect that has been picked up in some of the standardized test results. And if I'm looking at that and thinking, could there be a structural break around 2007, leading to a lower sloped line afterwards, then maybe, until we figure out how to use that technology in a way that is actually helpful for productivity and for, human welfare, maybe we will be in a lower regime. I don't know. Have you considered that?
Yeah. Yes, we did. I guess we have thought a bit about that. Obviously, when we did our tests for structural breaks, we haven't identified a structural break in 2007, but maybe that is a reflection of, we don't have enough data in the model yet. Obviously, this data only goes to 2019, so maybe in a few years' time, when we have more data, maybe that something that we'll see.
Yeah, I just echo that point because it seems the exponential model requires new ideas to interact positively with all existing ideas, as well as interacting positively with new ideas taking place at that moment and in the future. And who's to say that is the case with technology? Because we could be changing our behavior to take more advantage of leisure time.
Yeah, absolutely.
And other priorities.
Yeah. I don't think the additive growth model is necessarily wedded to the idea that each structural break breaks upwards. It's sort of agnostic, I think, about that. The way I sort of think about learning to use new technologies and the effect it would have in this sort of framework is generating lags before an upward break rather than generating a downward break. Anyway. Oh, sorry. Yeah, I think you had a question.
Just looking at your graph, on the trend, there's a break seemingly about 1990, and then it shoots up, and then about, say, 2005, it declines. I mean, what are the triggers then? I think that's really my question is, what seemingly there are breaks there. What were the triggers that changed the product?
Yeah.
Actually, I don't expect an answer. That's usually, you look at the data in detail, something going on.
Yeah, I mean, so I think there's a difference between a break and a deviation above or below a linear model. You're right, there's definitely an uptick in TFP increments around the 90s, and I think we're probably all have some ideas as to why that would be. Structural reform, potentially some ICT stuff as well. In terms of why we've seemed to have sort of dipped down underneath that linear trend line in the mid-2000s. I guess that probably goes to which of those factors on that big long list you subscribe to. I guess the paper doesn't really sort of take a strong view on that. Personally, I think it's probably it's probably a combination of quite a few different things. Anyway, Matt.
So assuming that the additive growth model is the model, and what implications does that have for policy, if any? Does it suggest anything about the capacity of policy? Does it change the way we think about policy under this model?
So one of the things I like about the model, it reveals really some differences across countries. So like when you look at the US, I keep having to go past that slide. When you look at the US, there sort of is very little slowdown there, at least compared to historical averages. Maybe very, slightly below 1990s, but yeah, the US doesn't seem to have much of a slowdown when you look at TFP increments. But Philippon finds that for the Euro area, there is still, and for Japan as well, there is still a slowdown even when you look at TFP increments in this additive framework. And Australia is probably somewhere in between those two things. Like, most of the slowdown seems to be sort of explained by this additive framework, but there is still this slight, deviation below linear trends. And I think I sort of like that because it changes the productivity growth slowdown narrative from this like global phenomenon with the implication that we can't change things, like policymakers in each country can't change things because it's a global thing that's affecting everyone. And it changes it to, it reveals differences across countries, and it sort of shines the light back on policymakers. Like, what is the Euro area and Japan doing that America isn't doing, or vice versa? So I think it actually sort of, shines more of a light on policymakers across countries in terms of like what like the sort of role for government here. Like, I mean, just on the my immediate thought would be, if under these models, these structural breaks and these new productivity regimes and these GPTs seem to be very important. And so I guess it's a pretty classic answer, but governments have a role, I think, to ensure that their sort of regulatory settings allow us to like harness those new general purpose technologies and allow us to sort of get the productivity gains from them.
Great preso. It was really interesting. Yeah, I think I think it's interesting, you could maybe do some eyeball econometrics and say that's a business cycle there. I just wondering if you could kind of detrend out your business cycle. Maybe you're starting to look a lot closer to additive, that's taking some view that there's a relationship with TFP and where the economy is relative to potential. And maybe not really a question, or a statement for me, for policymakers, if you're a macro policymaker, I think one thing you could take from this is it doesn't really change what you do. It gives you potentially better productivity forecasts, but then the decisions you're going to make are still, you're plugging in a better forecast, but your decisions around what you do with your instruments is kind of the same.
Yeah.
But I think if you're a legislative policymaker and you take seriously the idea that there's an issue of ideas having to interact with more ideas, and that's a drag, and that there's probably a lower yield than just trying to finance new ideas, it could arguably say that pushes the favour towards productivity policy that is trying to remove the ideas that need to be interacted with. So toward a sort of deregulatory argument a bit stronger.
Yeah, I mean, I hadn't really thought of that. Yeah, I mean, in terms of business cycles, I think that'd be like a pretty interesting like extension to this paper. We didn't really sort of do any detrending in our stuff. I think that'd be a pretty good idea for future. I can come up and present it again. Go second moment in the sun.
The people in the room have the advantage with the questions, so we'll just look at the questions online. Angus, so from Alistair Robson, there seems to be an assumption that each idea is worth similar value. Do you think an idea for, say, engineering would add more to production than, say, for the humanities? Could this analysis be done for individual industries and types of research to split out this effect?
Yeah, I mean, so we didn't do any analysis split by different industries. I think that would be like a pretty interesting, again, not just to cop out and say, future research, but like I think splitting it by industries could be interesting to look at something like Acemoglu put out a recent paper on sectoral bottlenecks, just saying that basically innovation isn't translating to TFP in the same way as it used to because of a lack of innovation in key upstream sectors that are creating bottlenecks and meaning that all the innovation going on in downstream sectors isn't translating through to TFP. I think looking at this sort of model by industry might let you might sort of shed a bit more light on that. I mean that's not something we looked at in our paper.
Second question from Angus Wheeler, I guess is basically raising the possibility of trying to unpack the different contributions of public funded, private funded research and best measures we have of research output is patents. That's what Angus is referring.
Yeah, I know it's a good question. Like, how good are patents and citations as a metric of useful ideas? And that paper that I referenced at Kelly et al. They look at quite a few different measures of useful ideas. So not just patents and not just citations, but they construct some really sort of fancy index. So I would sort of, I guess, for more sort of info on that, I'd probably refer you to that paper.
If productivity is sort of the secret source of economic growth, what's
that stolen from? I think it was literally directly stolen from Ross Gittins' screenshot.
I stole it from somewhere, so probably that. Then what is this finding mean for living standards going forward? And is there a scope for or a need for more redistribution if the pie is not going to keep lifting everyone?
Yeah, so I mean, so there are like lots of other things going on in living standards. It's not just labour productivity, but sort of labour productivity is a key determinant of living standards over the long run. Under this sort of additive model, labour productivity will be increasing in these ever increasing increments. So slightly faster growth than linear, but yet not exponential. But it implies that there won't be this sort of stagnation in labour productivity and therefore to living standards over time. But it doesn't really have any sort of, we don't really have any, I guess, any views on the other sort of things that feed into living standards.
So notice that the first structural break that we saw in your series was around 1850, right? And you were talking about the steam engine. I'm sure the steam engine was very important, but another thing that happened in 1850 or around then was the discovery of sanitation as an important driver of human health and longevity. And so you see that that's the point when, longevity increases start happening. And I would imagine that productivity at work would also start increasing because people are carrying fewer parasites, they're just able to focus more, all sorts of things that would impact the human component of the labor productivity. So I know that, you're dealing with this sort of lag thing and trying to figure out like how would you predict the lag from a new invention? If it's an invention like that, it should be pretty quick. And that did happen in the mid-1800s. And I'm also thinking about what's happened more recently. We haven't really seen much of an increase in longevity in the last few years. We're kind of plateaued out there. And if previous years in your series have benefited from a little bit of incremental increases in health, and we've now stopped having those, despite huge amounts of spending on the health sector, of course, maybe that could be part of why we're falling off trend.
Yeah, no, I think that's interesting. I mean, the reason we spent so much time talking about the steam engine around 1830 is like sort of all the research done by people like was David and Field, these sort of big economic histories that focus really strongly on the steam engine. I'm sure, I can imagine there could be a lot of other things that were happening at the exact same time, and maybe that is the source of the structural break.
Right. No further questions.
In chats, they may have put questions intended to be answered in the chat window. Is that just Q&A? Okay.
That's it. Right.
Okay, the points, Agnes, that is, I think, and, potentially quite a profound, issue that's been raised, because we're kind of used to thinking in terms of exponential growth. And, if exponential growth, continues even at a low rate over a long enough period, the economy is going to get bigger and bigger, and it's difficult to contemplate what that might actually look like. So watch this space.